Why does Congress allow interest or gains in a life insurance policy to accrue tax-free against tax revenuers' wishes? By the end of this video episode, you will understand why for more than 108 years, as of the recording of this episode, permanent life insurance policies accumulate money tax-free. You can access that money income tax-free, and when you pass away, it transfers totally income tax-free. So I'm Doug Andrew. I've been a financial strategist and a retirement planning specialist now for north of 48 years. And during that time period, I've been very, very blessed and grateful for the receptivity of over 12 books now that I've been able to author. I have a lot of other books in me that I want to publish before I check out. I turned 70 here in a couple of months, and no, I do not color my hair. Everybody asks that on this channel. But the purpose of this three-dimensional wealth channel is to give you insights into opportunities that maybe you did not know existed before. And I have taught over 90,000 hours in educational seminars and live events to audiences in excess of 20,000 people. And many times people will ask, well, Doug, it's obvious your favorite financial instrument where you think people at retirement in particular ought to have 40 to 60% of their retirement assets generating cash flow or retirement income that doesn't even show up on their 1040 tax return. Yep, that's correct. And that is in a max-funded indexed universal life insurance policy. That's where I put my serious cash, and many savvy investors choose to do the same. Now, sometimes people go, oh, what? Is this legitimate? Yes. I mean, it's been around for 108 years in the Internal Revenue Code under 3 sections that today are known as Sections 72E, 7702, and 101A of the Internal Revenue Code. In a nutshell, Section 72E says that the interest, the growth, the dividends, whatever, that happens inside of a life insurance policy in a permanent policy that accumulates cash values, because you're overpaying, you're overfunding the policy in excess of the cost of the actual term insurance mortality cost of the policy. You're building up equity in the policy. That grows tax-free, and that is provided for under Section 72E of the Internal Revenue Code. And people say, well, why does Congress allow that? Well, believe me, there's been many times tax revenuers who were hard up for money wanted to tax those, and I'll talk about different studies they've done in the past. But basically, when you are accumulating money tax-free inside of an insurance policy, it is helping the government to not have to provide welfare benefits to widows and orphans and so forth, or if you're going to use it as a living benefit, like I do, instead of just the death benefit for tax-free income, it's tax-free because I took pressure off of the government. I took ownership instead of relying on the government to provide for me with Social Security or additional welfare benefits or what have you. So they've been smart enough thus far to say, no, leave these tax-free because it's actually saving us money. It's not costing us money by allowing these things to be tax-free. We don't want to have to be providing benefits to more widows and orphans and people outliving their money in retirement, okay? So it's been a sacred tax-free cash cow under Section 72E. Now, back in 1980, E.F. Hutton, who was a brokerage firm, they weren't an insurance company, they realized that life insurance was primarily viewed as a death benefit or death insurance. And they said, what are we thinking? Why don't we maximum fund an insurance policy? Instead of taking the amount of insurance that we want, the coverage, let's say $1 million of life insurance coverage, and trying to shop for the least premium, like term insurance, let's flip it and let's take the least amount of insurance we can get away with under the IRS rules, under their definitions of life insurance, and put in the most money, the most premium that the IRS allows, And under Section 72E, it will allow you to grow the money tax-free, but you can also access money while you're alive, totally income tax-free, to provide tax-free income or tax-free working capital for your business and so forth. This was brilliant. And so this was the emergence of universal life, because whole life was designed to overpay the early years, underpay the latter years, but it was built on the chassis primarily for death benefit. Universal life was originally designed to be used primarily for living benefits. And so this is provided under Section 72E, but when you go to access money, if every $1 million you accumulate inside of a life insurance policy can generate $70,000, $80,000, $100,000 a year of tax-free income, which would be like a 7, 8, or 10% payout without depleting the $1 million principal, that outperforms the financial services industry standard of a 4% payout, which is called the 4% rule. It's more than double, and it's tax-free. So this became the preferred instrument for savvy people, so they could accumulate their money tax-free and then generate or turn on tax-free income. Or business owners, they can access money tax-free anytime they want as working capital for their business or maybe their real estate investments, what have you, okay? And so this was incredible, and that's under Section 72E and 7702. 7702 talks about how you can access money out of the policy while you're still alive. And there's the dumb way and there's the smart way. Okay, the dumb way is by withdrawing money. It's tax-free until you've recovered your basis. If you put $500,000 of premiums into an IUL policy, and after you have $500,000 in there, earning average returns like I have, at 9.6% in 7.5 years, it doubles to $1 million. Or if you're earning 7.2%, it doubles to $1 million in 10 years. And then if you don't need the money, it'll double from $1 million to $2 million in another, 7.5 to 10 years. And so it accumulates tax-free. But to be able to turn on income, if you do the math, if it's earning average returns of, let's say 9%, $1 million can generate $90,000 a year of income without depleting principal. That's pretty incredible. When a lot of times people who have money in the market, the 4% rule says on $1 million in the stock market, you're only supposed to pull out $40,000 a year, which is pretty pathetic, and you have to pay tax. You pay tax even at a 25% tax rate. That's $10,000 of the $40,000. You're only netting 3% or $30,000, and out of a max-funded insurance contract, you can pull out $90,000, 3 times as much money, and it's totally tax-free. This is why it's so incredible. And naturally, people then ask, well, is this legit? Why does Congress allow you to do this? To be able to accumulate money tax-free and then be able to access the money tax-free under those 2 sections of the code. Again, it's because it's taking pressure off of the government to provide benefits for you. You're taking ownership for your retirement as a living benefit, and also if you die and you leave behind widows, orphans, that they will not be a drain on society or social dollars, taxes, okay? And so it's been sort of a sacred tax-free cash cow in the Internal Revenue Code. And of course, Section 101A says at the end of the day when you die, anything left in there usually will transfer tax-free, but it blossoms oftentimes, meaning that if I died tomorrow in an accident, every $1 million I might have would maybe blossom to $2 million and transfer tax-free, because now it's transferring out in an actual life insurance death benefit, and those have always been tax-free. Why would you tax life insurance that's designed to help widows and orphans be financially independent and not outlive their money and be taken care of? Does that make sense? So even though it's been a sacred tax-free cash cow, so to speak, whenever government gets hard up for money, they always think, should we tax this? Should we go pluck this little luscious plum that has trillions of dollars sitting in there that's not subject to income tax? Now, ever since 1986 tax reform, there's only 3 types of income that Americans pay income tax on, and that's earned income, passive income, and portfolio income. If you have income in retirement that does not fall under the definition of earned income, wages, and salaries, passive income, which might be rents and leases, and portfolio income, which might be interest and dividends, there's nowhere on a tax return to put it. It's tax-free. It's that cut and dried. But you wouldn't believe there are tax revenuers that when they want to pass all of their little spending packages, they will do studies to see, hey, maybe we ought to tax life insurance. And so the last big time I remember doing this, because I started in 1974, and they came so close, and it was in 1990. So in 1990, actually, the General Accountability Office, okay, and also this was a report that involved the Committee on Finance, the U.S. Senate, the chairman on House Ways and Means, Senate Finance Committee. They all did this big, huge study for months. And this was the summary right here in this report. And in a nutshell, when they went through, they said, should we tax the inside buildup of cash value inside life insurance? Number one. The second big consideration is when people go to access money and they're still alive, we think they should be paying tax on the gains. And they went through a study, and even though they tried to convince the tax revenuers who wanted to find some money to spend, even though they recommended that they be taxed, the majority ruled and said, you know what? That's not a good idea. It will cost us in the long run more than it makes us in the short run. And they were smart enough to say, no, leave it alone. And so far, so good. Now, in other episodes, I'm going to talk about how even if they change the rule in the future, I think we would be protected if you owned one because of grandfathering, the ex post facto provision of the Constitution. But if this is intriguing you and you're going, wow, I think I want one of these, I want to gift you a copy of my most recent 300-page best-selling book. It's called The Laser Fund. This will teach you how to diversify and create the foundation for a tax-free retirement. And you'll understand how a max-funded IUL structured correctly and funded properly would qualify to be called a laser fund. Laser is an acronym that stands for Liquid Asset Safely Earning Returns. Okay? And so you have to structure it correctly and fund it properly. This will teach you how. This is actually 2 books in one. This side is about 200 pages, 14 chapters, with all the charts and graphs and explanations if you're a left brain learner. If you're more of a right brain learner, you flip the book over and read this one. This is 100 pages, 12 chapters with 62 actual client stories of how a properly structured IUL policy could be deemed a laser fund to be used for all kinds of goals, not just retirement, emergency planning, real estate, working management and capital and so forth, all kinds of uses. It knocks the socks off of a 529 college savings plan, okay? You'll gain insights as you read this. And I would recommend you read both. Use your right brain and left brain. Here's how you can claim your free copy. You simply go to laserfund.com, laser-fund.com. Click on the link below. And you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll pay for the book. I'll send out a hard copy to you, but there's options in there too. If you like to listen and learn, watch and learn. There's also some information if you want to join an online webinar and also talk to a specialist to see how this may apply to your particular set of circumstances. But this is about you and your brighter future.